Welcome to episode 10 of Double Standards in India, where we examine the complex comparative timeline of global trade, sanctions, and energy policy shifts across international commodity markets from 2022 to 2026. On February 24, 2022, the onset of hostilities in Ukraine triggered immediate international condemnation and unprecedented economic measures, instantly altering the trajectory of global energy markets and multilateral trade agreements. Between March and May 2022, the United States, United Kingdom, and European Union announced formal bans on direct imports of Russian crude oil and coal, forcing European capitals into emergency diversification planning. In June 2022, the European Union adopted its sixth sanctions package, formally establishing a phased embargo on seaborne Russian crude oil imports and reshaping maritime logistical chains across the continent. On December 5, 2022, the G7 coalition, European Union, and Australia instituted a $60 per barrel price cap on seaborne Russian crude oil, backed by prohibitions on maritime insurance services. By February 5, 2023, the European Union implemented comprehensive bans on Russian refined petroleum products including diesel, gasoline, and jet fuel, alongside secondary price caps established by Western coalition partners. According to Kpler and Vortexa shipping data, Indian seaborne crude imports from Russia surged dramatically, rising from under 2% of total imports prior to February 2022 to over 40% by mid-2023. Major Indian coastal refining hubs such as Vadinar, Jamnagar, and Paradip processed discounted Russian Urals feedstocks, transforming India into a significant exporter of refined petroleum products to global markets. Academic consensus and economic analyses confirm that Indian hydrocarbon purchases fully adhere to the legal exemptions built into Western sanction architectures, despite complicating international enforcement efforts. Official statements from United States and European Union trade representatives acknowledged that Indian refining and export activities help stabilize global oil supply and prevent catastrophic market price spikes. Data from Eurostat and the Center for Research on Energy and Clean Air demonstrate that European nations continued importing billions of euros worth of Russian liquefied natural gas, fertilizers, and critical industrial metals. Russian exporters successfully rerouted their supply chains using a massive shadow fleet of aging tankers operating outside Western jurisdiction, utilizing non-Western insurance pools in Russia, the UAE, and India. Throughout 2024 and 2025, the U.S. Office of Foreign Assets Control progressively tightened secondary sanctions, increasingly targeting shadow fleet vessels, third-country financial institutions, and specific LNG infrastructure projects. The government of India maintained that its energy procurement policies are driven strictly by national interest and energy security, ensuring affordable supplies for 1.4 billion citizens within legal frameworks. World Bank and International Monetary Fund analyses indicate that while the G7 price cap did not immediately cripple the Russian economy, it structurally redirected capital flows and forced significant fiscal adjustments in Moscow. By 2026, global trade has transitioned from a unified post-Cold War globalization model to a fragmented, multipolar trading architecture defined by bilateral currency settlements and regional supply chain resilience. As we conclude episode 10, the evidence confirms that trade policies between 2022 and 2026 reflect selective decoupling rather than total embargoes, setting the stage for episode 11's investigation into financial messaging architectures. Comprehensive documentation from the UN Comtrade database, IEA market reports, and Eurostat trade records form the empirical bedrock of our investigation into comparative global commodity policy shifts. Baltic export terminals at Primorsk and Ust Luga served as primary logistical bottlenecks where Urals crude was loaded onto tanker fleets bound for non-Western destinations across Asia. Black Sea port facilities in Novorossiys remained vital maritime exit points for Russian agricultural and energy commodities navigating toward the Mediterranean and Suez Canal corridors. Ventspils and Murmansk along northern maritime passages provided alternative logistical nodes for Arctic liquefied natural gas shipments and specialized northern sea route cargo transports. Global seaborne crude trade volumes shifted significantly, with over 1.5 to 2 million barrels per day redirected away from traditional European buyers toward Asian markets in India and China. Cumulative European Union spending on Russian fossil fuels exceeded €200 billion since February 2022, sustained by pipeline gas, liquefied natural gas, nuclear materials, and raw industrial metals. Executive Orders 14024, 14066, and 14068 issued by the United States government established the statutory foundation for sweeping financial restrictions and targeted sectoral trade prohibitions. Critics of the G7 price cap argued that enforcement gaps and widespread use of non-Western maritime insurance allowed Russian exporters to maintain robust revenue streams during periods of elevated global prices. The government of the Russian Federation maintained that Western sanctions violated foundational free market principles, asserting that trade had successfully reoriented toward friendly economies across Asia and the global south. The Strait of Malacca and the South China Sea emerged as vital maritime transit corridors for the massive volume of Russian energy exports destined for refineries in East Asia and South Asia. Between 2022 and 2024, the European Union progressed through successive legislative rounds, culminating in its 14th sanctions package designed to plug enforcement loopholes and restrict indirect transshipments. Ministry of Commerce and Industry data from India revealed that bilateral trade turnover with Russia expanded exponentially, driven primarily by discounted crude oil and fertilizer imports. Energy market analysts noted that Indian refineries achieved significant margin enhancements by processing heavy sour Russian Urals crude, which traded at steep discounts relative to Brent benchmarks. Vadinar refinery in Gujarat, operated by Nayara Energy, became one of the primary coastal processing facilities handling large volumes of seaborne Russian crude feedstocks under compliant operational licenses. Paradip refinery on India's eastern coastline similarly adjusted its crude slates, integrating discounted Russian grades to optimize operational economics and satisfy growing domestic and export product demand. International shipping intelligence reports documented that non-Western tanker registries expanded rapidly, with registries in flag states outside the G7 absorbing hundreds of displaced crude carriers. Financial researchers emphasized that alternative settlement mechanisms, including bilateral local currency arrangements, were increasingly utilized to bypass traditional dollar-denominated clearing systems for commodity transactions. Official guidance documents issued by the G7 Price Cap Coalition in December 2022 detailed strict attestation requirements designed to verify that crude purchases complied with the established price ceiling. UN Comtrade international merchandise trade statistics confirmed that European imports of critical industrial metals from Russia, including nickel, titanium, and palladium, experienced selective exemptions. Commodity market observers highlighted that nuclear fuel contracts involving Russian state atomic energy corporations remained largely insulated from sweeping sanctions due to Western reliance on specialized VVR reactor supplies. The Cape of Good Hope alternative maritime route witnessed record tanker traffic as vessels bypassed traditional Suez Canal bottlenecks to navigate around the African continent amid evolving security assessments. Fertilizer trade statistics compiled by international agricultural organizations revealed that Russian potash and nitrogen exports continued flowing to developing economies under explicit humanitarian carve-outs. The Ministry of Petroleum and Natural Gas in India repeatedly emphasized that national procurement strategies prioritize commercial viability, supply diversification, and energy affordability above external geopolitical pressures. Economic historians evaluating the 2022 to 2026 timeline concluded that secondary sanctions enforcement created a two-tiered global market where compliance costs increased friction for legitimate trade participants. Vortexa analytics demonstrated that refined diesel shipments originating from Indian coastal refineries found ready buyers across Europe, offsetting supply deficits created by direct EU embargoes. Congressional Research Service reports in the United States cataloged the extensive legislative hurdles and enforcement challenges associated with monitoring multi-jurisdictional petroleum product laundering. Strategic research institutes noted that the rapid reconfiguration of global trade corridors demonstrated the remarkable adaptability of private shipping networks in circumventing unilateral state embargoes. Pacific Basin maritime routes facilitated increasing volumes of Russian crude and coal destined for industrial ports in northern China, cementing bilateral trade ties across East Asian energy sectors. International Energy Agency market reviews confirmed that global refining capacity reallocation successfully averted catastrophic supply shortages during the initial implementation phase of Western sanctions. European Commission policy statements emphasized that the ultimate objective of successive sanction packages was the systematic degradation of Russian state revenues over the medium to long term. Trade compliance experts observed that the introduction of digital tracking and mandatory vessel certification added unprecedented administrative burdens to international maritime commerce. Global trade data repositories indicated that bilateral currency settlement agreements between emerging economies and resource exporters grew by over 300% between 2022 and 2025. Jamnagar refining complex in Gujarat operated as the world's largest refining hub, processing diverse crude slates that included substantial quantities of discounted Russian feedstocks for global distribution. Geopolitical analysts concluded that India's strategic autonomy model served as a blueprint for other emerging economies seeking to navigate great power competition without sacrificing domestic economic imperatives. Official customs declarations across multiple jurisdictions documented the complex web of intermediary re-exports that blurred the ultimate origin of refined petroleum products entering international markets. Comprehensive shipping intelligence archives maintained by Kpler showed that shadow fleet operations accounted for over 35% of total Russian seaborne crude exports by late 2024. United States Department of the Treasury enforcement advisories repeatedly warned financial institutions worldwide against willful blindness regarding illicit shipping networks and price cap evasion. Final economic assessments for the 2022 to 2026 period established that global commodity markets have permanently shifted toward regional fragmentation, decentralized supply chains, and multi-currency clearing architectures. As our comparative timeline reaches 2026, the documented evidence reveals a transformed global trading order where strategic autonomy and economic resilience dictate international relations, concluding episode 10 of our evidence files.